Hey everybody, welcome to the first video on the channel here at 45 Finance. Interesting headline to go ahead and start out the video. A shocking number of Americans are living paycheck to paycheck. This is an article from a few months ago on MarketWatch, and even just going down later on within the article, you can just see the stats here. 1 in 4 families making $150,000 a year are living paycheck to paycheck. 1 in 3 that are earning between $50,000 and $100,000 are also living paycheck to paycheck. Now, this is a financial future that I don't want anyone to have to go through. I'm going to go ahead and give you guys my story, my roadmap about how I'm going to go ahead and get started to make sure this doesn't happen to me. And I just want to go ahead and give some exposure to everybody else that this doesn't have to be them. So what we have here, this is what's called the personal finance flowchart. This is on the personal finance Reddit, and there's a lot of great information on that Reddit if you prefer to read. However, I'm just going to go ahead and just go over the basics here about how you can start to get a good financial footing so that you're not living paycheck to paycheck. And then how you can take that good financial footing and turn it into a little bit more until that little bit more turns into even more, that even more turns into a lot more. And then after 20, 30 years, you're looking at a good lump sum for retirement. So it all starts at the beginning. And the first thing it mentions is to create a budget. The first thing you want to do when you create that, you want to go ahead and take care of all the necessary things first. What that would consist of would be your rent or your mortgage. Then after that includes any food and groceries, the basics that you need to stay alive. The third thing on the list would be to pay any essential items like any utilities like gas, power, water, things along those lines. After that, you want to pay for any necessary expenses for earning an income. If you have to commute to work, that includes any gas, car repairs, insurance, or if you go public, tickets, Ubers if you do that. But whatever it is, just make sure you take care of those first. Those are essentials to make sure that you continue earning an income. And a good baseline is that shouldn't be more than 50% of your monthly income. If it is more than 50% of your monthly income, you might want to go ahead and cut that down. And just a quick aside here, I have a little breakdown of monthly income. Your needs should be 50%, which are the things that we just mentioned. Your wants should be 20%, so that includes anything discretionary, like going out to eat with your friends or going to see a movie, making a purchase on Amazon for something that you probably don't need, anything along those lines. And then the last 30% of your monthly income, that should be used to go ahead and start establishing your good financial footing. So once you've paid off those essential things, once those bills are paid, that's when I actually go ahead and make my investments. I'll make deposits into my brokerage accounts. I'll make deposits into a 401k if I get any company match. And I'll also go ahead and make minimum payments on any debts that I have, for example, student loans for those of us that are just coming out of college. That's the next part I do after the 50% from these things here. And from there, like I said, the more you're able to save from these initial needs, the more you'll have to go ahead and start building up your financial cushion. The first thing you want to do when building your financial cushion is, even before this part right here about the emergency fund, I go ahead and put 1 month's worth of expenses within my checking account as a buffer. From that 1 month of expenses, you can add in another month, because if you pay your bills out of your checking account, you want to dwindle it down to your baseline balance of 1 month. So always leave yourself a 1 month buffer in your checking account. And the way you do that is by saving money in other areas. Once you go ahead and have that 1 month buffer, then that's when you can go ahead and move your what we call an emergency fund. Your emergency fund would be anywhere between 3 to 6 months of living expenses set aside in an easily accessible account in case anything were to happen, like a layoff, a medical emergency, or anything along those lines. And of course, you don't have to do that all in one paycheck. Make sure you're still allocating your money to the needs with every paycheck. And you can also still spend your money on things that you want as well, but make sure you're setting aside a little bit of a portion to go ahead and build up your emergency fund. Your emergency fund is what will allow you to take the jump to start investing. And that's the point where I'm at now. I've successfully built up a cushion in my checking account for monthly expenses. I've built up a solid emergency fund that I can use to go ahead and fall back on should anything happen to me. And from there, I've begun to invest and let my money work for me. When you do go ahead and start investing, the first thing I want to mention is don't be scared if you see any red, especially if you're still young. In the market that we're in right now, I actually think this is one of the best times to start investing, just so you can get a gauge of how much risk you can take and how much you can deal with. Me right now, as you can see, I'm already down 23%, but I do believe that the stock market will always continue to go up. Not right now. It'll probably be a couple months or maybe even a couple years until we're back at the levels when I first started investing in December. However, don't be scared about it. Start putting your money in, because over time, this money will grow. In 10, 20, 30 years, you'll have lots of money. This amount will have grown by a lot. You won't even see this as a blip on this graph once it's stretched out 20 to 30 years. But that's besides the point. What we're doing right here is this is my investments. I have two different accounts here. One of them is a Roth IRA, which is a retirement account. And then I also have a brokerage account, which doesn't have any retirement benefits. It doesn't matter what platform that you do this through. However, I do prefer to use M1 Finance just because it does automatic rebalancing. It keeps you with your target percentages, how much you want to invest. It also allows you to purchase fractional shares. If you look right here, VTI is probably worth over $150. My mistake, it's currently at $123. But say I only put in $100 per deposit. I'm still able to purchase this, but I'm not able to purchase the full share. I might purchase 3/4 or half of a share. But that's great. It allows for more compounding. That's exactly what you want to see. A lot of other brokerages don't offer fractional shares. M1 Finance does. It also offers automatic rebalancing. And that's what I use. And thank you to Joseph Carlson for putting me onto this. That's another YouTuber who does videos like this. I'll put his link in the description. Once you get yourself a sound financial footing, you can begin to invest like this. I have some money sitting in a Roth IRA, and I have it broken up between two different funds. This is called index investing. It's nice and easy. You have a fund manager who goes ahead and invests the money for you. You just purchase the fund that they manage. And the one fund is the total stock market. It just tries to match the returns of the United States stock market. This other fund is an intermediate term treasury fund. What this does is they purchase treasury bonds from the government, usually between 3 to 7 years. And what this does is it provides a buffer against this return here. So basically, when this is going down, this will go up a little bit. If you take a look at my all-time return so far, this is going down by 27.8%. This is going up by 1%. So basically, it keeps you afloat in the bad times. That's one way of investing. The other way is through what I call dividend growth. Now, let me go ahead and load that up for a second. So here's my dividend growth portfolio. Now, this is something quite a bit different from the two fund portfolio that you had just seen. There's actually 33 separate holdings in here. Most of them are individual companies broken up into their sectors, like so. And this is where you really see the greatness of M1 Finance. I'll go into this more in the future. But when you have this many different pies, is what they're called, there's a lot of math involved with getting the right allocation percentages. If I was doing these purchases myself, I would have to spend a lot of time deciding which individual stock I have to buy to make sure I'm hitting these percentages. But M1 Finance does it perfectly for me. If you just take a look at these details, it's calculated out exactly how much of each fund or each stock that I have to buy, which I think is incredible. But just to go ahead and explain what this is, dividend growth investing is something that was popularized by Joseph Carlson, whom I had mentioned earlier. The basic idea behind it is that you grow your month-to-month dividend income to the point where you no longer have to pay for your living expenses through your job. It's a way to achieve financial freedom. And these are the two ways that I'm going to go ahead and do it. I'm going to do dividend growth investing to cover my monthly expenses in the future. And through the Roth IRA, I'm just going to go ahead and slowly accumulate my wealth. And I'll just go ahead and let Vanguard's funds go ahead and do that for me. What I really want to get at, and the point of this video is that once you create that budget and you pay off your needs, if you're able to save a lot of money, you can put that towards your retirement. Now, just moving back over to my portfolios, I've currently put in $1,600 since December, or the end of the year actually. So we'll just say from January 1st up until now, I've made $1,600 of contributions into the IRA, and then only $476 into the other portfolio. So $2,100 is what I've put in over a period of about 4 months, and I'd like to increase that a lot. And the way I can increase that is if, for example, this is obviously something very simplified, but if I'm able to drop my percentage of income that goes to my needs by 10%, and I'm able to decrease my discretionary spending, things like movies or going out to eat, by an additional 10%, that opens up a lot more money to go ahead and put into my retirement accounts. I already built up my cushion. I already have an emergency fund. So now I need to go ahead and start aggressively funding my portfolios. And the way you aggressively fund that is by living below your means. You don't do unnecessary things, you don't spend unnecessary money, and you try and cut back on your costs as much as possible. If I'm able to go ahead and get this up to, let's say, $1,000 a month, $2,000 a month, or even $3,000 a month, my portfolio would rise in value very, very quickly on both sides. On my IRA, I'd be putting in a lot more, owning a lot more of the stock market. And then on the dividend growth portfolio, I'd be owning a lot more companies, which would continue to pay me month over month, year over year. And with those dividends, I can just use that to go ahead and repurchase. M1 Finance has an automatic invest. If your minimum is if your cash balance is $10 in here, M1 Finance will automatically go ahead and purchase any underweight holdings. So you have immediate compounding anytime you receive dividends. And with that, that's how I'm going to go ahead and create wealth. And the biggest thing is, the more you save, the more money you can put into your investments, and the more money that you can put to work for you so that you become wealthy in the future. So that'll just about wrap it up for this episode, guys. Obviously, if you take a look here at the portfolio, there's a lot going on. I have a big deposit coming in, almost 50% of my current value is coming in and buying a lot of things. A lot of things are underweight. I recently changed some percentages around. We'll go into some more detail about dividend growth investing as well as my IRA. But really, I want to just go ahead and get this first video out of the way, make people familiar with the channel, and get people thinking about getting a good financial foundation set up. I'll be looking forward to any comments if you have any. There's also an email in the description if you want to go ahead and email me there. I do have Twitter and Instagram, so you can always go ahead and check me out on there. Also, if you have any comments about your strategies and any criticisms about mine, I would love to hear them. Thanks for checking in with 45 Finance, and I hope everybody has a wonderful day.